Welcome back to the deep dive. If you're tracking the crypto space, you, like us, have probably spent the last few weeks watching the price action of Pi Network and, well, scratching your head a bit.
It really feels like that, doesn't it? Like, this project exists in two completely separate realities right now.
Exactly. So, in one reality, you look at the charts, and they seem incredibly bullish, signaling maybe a massive technical reversal, suggesting some real momentum.
But then in the other reality, the critics are maybe louder than ever, still calling it, highly centralized, a potential scam, fundamentally broken.
And that's precisely our mission today. We've got this stack of sources you provided, everything from technical analysis, on-chain data, to some pretty controversial historical reports.
Right.
And we're going to deep dive into the verifiable facts. We really need to figure out, for you, the listener, if this recent price surge, is it legitimate market momentum? Or is it market manipulation playing on those technical signals?
We need to cut through the noise on this one.
Let's do it. So maybe start with the snapshot. What's the picture right now, October 29th, 2025?
Okay, so right now, the price is hovering around, let's say, 0.265 to 0.275 USD, somewhere in that range.
Okay.
And the recent growth has been, well, intense. We're looking at over 35% up on the week.
35%, wow.
And get this, nearly a 96% surge over the month. That's since the low back on October 11th, which was around 15 cents.
96% in what, less than 3 weeks? That definitely catches the eye. That kind of volatility means capital is moving, for sure.
Yeah.
But we have to keep perspective, right? The all-time high, that was way up near $3 back in February 2025.
Yeah, $2.98 USD, roughly.
So even with this huge jump, the price is still down, what is it, over 91% from that peak.
Exactly. That massive drop really tells a story about the instability here. But, despite that, the market cap right now is still pretty substantial, somewhere between $2.18 and $2.27 billion.
Okay.
So there's significant capital tied up in this ecosystem, even now.
Right. Okay, let's unpack the technicals then. If this was purely manipulation, you'd expect the charts to look, I don't know, messy. Driven by quick pump and dumps.
You might think so, yeah.
So what are the charts actually telling us? What's driving this rally from a technical perspective?
Well, this is where it gets interesting. The technical patterns actually seem to lend some credibility to the move. They suggest it might be driven by more sustained buyer interest, not just a fleeting spike.
Okay.
We're looking at two key bullish reversal patterns, which is exactly why the technical traders are, paying close attention right now.
All right, let's break those down. What's the first one, the clearest confirmation?
That'll be the falling wedge pattern, and this one is confirmed.
Okay.
For anyone not familiar, it's a classic bullish signal. Price gets squeezed between two downward sloping lines, and when it breaks above that top line, that signals a potential strong reversal upwards.
And Pi broke that line definitively.
It did, yeah. The key breakthrough happened right around that 25-cent mark. So it's $0.25 USD.
Okay. And does that pattern give us a target?
It does. Technically, it points to a short-term target of about 0.3272 cent. So roughly 23% upside from where we are now.
23%. Not bad.
And some analyses, though they note it's highly speculative, suggest an extended target based on the wedge could even reach 50 cents.
50 cents, okay. That's quite a jump.
It is. Highly speculative, like I said.
Got it. So that's one pattern providing some technical support. What's the second one you mentioned? The one that's building?
That's the inverse head and shoulders pattern, or IHNS. This one's only partially confirmed right now.
Okay, IHNS. Bullish pattern, too.
Very much so. One of the more reliable ones. Actually, you can picture it like a person upside down on the chart, a dip for the left shoulder, a deeper dip for the head. That was the low point at 15 cents on October 11th.
Right.
And then another shallower dip for the right shoulder, which formed around 20 cents.
Okay, so the structure is there. What makes it partially confirmed? What's missing?
It needs to break the neckline. That's the resistance level connecting the highs between the shoulders and the head. In this case, it's right around that same 25-cent level.
Ah, okay, so 25 cents is key for both patterns.
Exactly.
Yeah.
It's basically ready to trigger, but it needs a clear, definitive close above that $1.25 neckline for full technical confirmation. It suggests sellers are running out of steam.
Makes sense. And beyond these classic chart patterns, what about other indicators? Like momentum?
Yeah, they're generally supporting the bullish case too. The RSI, the Relative Strength Index.
Right.
It measures momentum. It moved pretty dramatically from around 32, which is deep in oversold territory, often signaling a bounce is due, up to a more neutral zone, maybe 45 to 50. That's a clear sign buyers are coming back in.
Okay.
Plus, the 7-day moving average, which was around 21 cents, that's been clearly broken to the upside. So short-term momentum looks positive.
Okay, but hang on. Let's circle back to something we touched on earlier, that centralization issue. If, what was it, 96% of the tokens are held by the top 100 wallets.
Yeah, 96.37% according to the source data.
Right. Wouldn't that make any technical analysis, no matter how clean the pattern looks, inherently suspect? I mean, how can you trust these patterns if maybe just one or two big players could be moving the whole market?
That's an excellent question, and it really gets to the heart of the paradox with Pi right now.
Yeah.
Technical analysis fundamentally tracks what is happening in the price action, regardless of who is causing it. So if a whale, a large holder, decides to buy aggressively, guess what? Bullish patterns will still form.
Okay.
So the patterns confirm buying strength is present. What they don't confirm is whether that strength is coming from, say, broad, decentralized organic adoption or from a few concentrated sources.
So the patterns are real, but the reason they're real might be less than ideal.
Precisely. And that forces us, really, to pivot. We have to look at the project's history and the surrounding controversies.
Okay, yeah. This is where it gets, as you said, really interesting. Because despite these technicals looking, legitimate on the surface, the history here is just packed with red flags. Big ones, high-profile ones.
Absolutely. You can't really analyze Pi today without understanding the weight of these past events.
So where do we start? Maybe with that scam label from early 2025.
Yeah, let's call that controversy A, the scam label. February-March 2025. This was huge in terms of public perception.
I remember the headlines. It was Ben Zhu, right? The CEO of Bybit?
That's the one, major crypto exchange CEO. He publicly called Pi Network a scam, said it was more dangerous than meme coins, and flat out stated Bybit would never list it.
Wow, that's about as strong a condemnation as you can get from a major industry player. How did Pi respond?
Well, the PiCore team naturally denied it strongly. They pointed to their, 6 years of development work, their huge user base.
Okay.
But the really extraordinary part was the community response. The pioneers. They apparently coordinated these massive organized attacks on Bybit's Google Play ratings.
Seriously, they tanked their ratings.
Dropped them dramatically. It showed just how passionate or maybe how defensive that community is.
An organized counterattack against an exchange CEO. Wild. Now, part of Zhu's critique, I think, mentioned anonymous founders. Was that accurate?
Actually, no. That specific bit is false. The founders, Dr. Nicholas Kukalis and Dr. Cheng Yao Fan, they're public figures. Stanford alumni. Well known in the project.
Okay, so that part was wrong. But the listing issue remains, right? Still not on the big exchanges.
Correct. Still no Binance, no Coinbase, no Kraken, and definitely no Bybit. That lack of major exchange access is a persistent issue.
Okay. Let's move to controversy B then. This was the mysterious token dump, the one that crashed the price.
Yeah, May 2025. This one shook confidence, too. A crypto analyst came out and accused the core team of selling off 12 million PI tokens.
12 million.
12 million. And it coincided with a massive price crash, 51% drop. Price went from about $1.67 down to $0.81 really fast.
Okay, so the crash definitely happened. What about the accusation? Was the core team linked to that sale?
Well, the price crash is a fact. And the on-chain data did confirm a huge, sudden outflow of tokens from one very large wallet around that time. But was that wallet officially connected to the PiCore team? No.
Yep.
That direct link was never confirmed by the team itself, and the analyst accusation wasn't, proven in court or anything.
So, circumstantial evidence, suspicious timing and movement, but no smoking gun.
Exactly. But that massive wallet movement, the lack of transparency around it, it definitely cast a long shadow, raised serious questions about who controls the supply and what they might do with it.
Right. And that leads us nicely into controversy C, the $100 million fund fiasco. This one seemed to cause friction within the community itself.
Yeah, this was a big narrative turning point.
Yeah.
Also, May 2025, Pi Network Ventures gets launched. The stated goal, to invest $100 million into building out the ecosystem, dApps, AI, gaming, things big on Pi.
Okay, investing in the ecosystem sounds good on the surface, right? What was the problem?
The problem was where that $100 million came from and who it wasn't going to. Remember, you've got millions of pioneers mining on their phones, essentially providing the network effect, the user base.
Right, they're the foundation.
And the sources suggest something like 94% of these pioneers hold very little Pi themselves, maybe less than 1,000 tokens each.
94% hold less than 1,000.
Wow. So the feeling was acute betrayal. Here's $100 million seemingly generated from the project's value, and instead of rewarding the early miners or providing liquidity or stability, It's going to fund external startups.
Yeah, I can see how that would feel like a slap in the face. How did the core team justify it?
Their argument was that investing in these dApps and tools would build real utility for the Pi token, which is essential for long-term value.
Okay, a long-term vision argument.
Right, but in the short term, the community felt the money should have gone to them, the ones who built the network. The PR around it was pretty disastrous.
So putting it all together, we've got legit-looking technical patterns suggesting growth, but layered on top of massive centralization risk and this history of controversies, opacity, and community friction.
That's the puzzle.
So how do we assess this current surge then? Back to the original question, manipulation or genuine momentum?
I think the most honest answer, based on the sources, is that it's likely a mix, leaning heavily on the high-risk, speculative environment created by that centralization.
Okay, break that down. What points towards manipulation?
Well, number one is that centralization itself, 96.37% in the top 100 wallets. That concentration makes manipulation possible, even easy for those holders.
Right.
Number two is the huge jump in trading volume, up 336%, without any really obvious, massive corresponding news event triggering it organically. That can sometimes be a sign of coordinated activity.
Okay, so concentration plus volume surge without clear news suspicion. What argues against manipulation then? Or at least supports some legitimacy?
Well, first, the technical patterns themselves. As we discussed, things like the falling wedge breakout are legitimate technical signals,
Right.
regardless of who's driving them. Second, there is some correlation with the broader crypto market rally. Bitcoin hitting $116,000 recently.
Mm-hmm.
A rising tide lifts many boats, even speculative ones.
True.
And third, there is real, verifiable, fundamental progress happening in the background, like the 3.36 million new KYC completions recently and the rollout of that Protocol 23 upgrade.
So the technicals are capitalizing on real, albeit risky, underlying factors.
That seems like the most balanced take. The momentum is technically real, but it's happening in an environment supercharged by centralization risk and maybe boosted by actual progress.
Okay, let's focus on that verifiable progress then. You mentioned KYC and Protocol 23. Let's separate the solid facts from the hype and noise.
Absolutely. This is crucial. The KYC Know Your Customer and the Mated migration progress. That seems to be the project's biggest tangible success story right now.
What are the numbers?
The core team's official report states 21.36 million total verified pioneers. That's a huge number of identified users. And critically, 10.14 million of those users are now fully identified on the mainnet. They've passed all the checks.
10 million on the mainnet, and migration is accelerating.
Seems so. In just the last week of October 2025, according to the data, 2.69 million users completed that full migration process.
Wow, okay. That is tangible, measurable progress. You're moving people from just phone tapping into the actual usable blockchain environment.
Exactly. And then there's Protocol 23.
Right. What does that actually do? Is it just a version number bump?
No, it's presented as a significant technological step forward. It's not just minor tweaks. It includes adding smart contract capabilities,
Okay, crucial for dApps.
essential DeFi building blocks, and an enhanced version of the Stellar Consensus Protocol that Pi is based on. This is real infrastructure work, foundational stuff needed to build a functioning ecosystem eventually.
Okay, so real progress on user migration and tech upgrades. Now, let's tackle the myths. The things that constantly circulate online, often creating unrealistic expectations. That ISO 2022 claim seems persistent.
Oh yeah, that one is just pure clickbait. And frankly, it's dangerous because it sets people up for disappointment.
So, myth #1. Pi gets ISO 2022 compliance on November 22nd, meaning automatic bank adoption, moon.
Totally false. First off, Pi Network is not on the official ISO 2022 Registration Management Group's list of compliant crypto assets.
Oh, okay.
Second, that November 22nd date. It's simply a deadline for banks and financial institutions to finish their internal migration to use the new messaging standard. It has absolutely zero automatic impact on the status or value of any cryptocurrency, Pi or otherwise.
Got it. Pure misinformation. What about the user numbers? I always see 60 million users thrown around.
Myth #2. Pi has 60+ million active users. This is, at best, highly misleading.
How so?
While the core team might claim a total user base or registered accounts number that high, the operational reality, the number of people who are actually KYC'd, migrated to mainnet, and can potentially transact or use dApps
Is much lower.
is much, much lower. Around that 10 million mainnet identified figure we talked about, the vast majority are likely still just in the initial phone mining stage. They aren't active blockchain users yet.
Right. Big difference between tapping a button and actually using a network. Okay. And myth, #3. The PiDX. Is it live? Is DeFi happening on Pi?
Myth #3. PiDX launched with full DeFi functionality. Also false, at least not on the main network accounts.
So where is it?
PiDX and the AMMs, the automated market makers needed for liquid trading,
Mm-hmm.
they're being developed and tested, but currently only on the testnet.
Ah, okay. Testnet, not mainnet. Big distinction.
Huge distinction. It means that actual real value DeFi isn't happening yet. It's still in the experimental phase. Limits the current utility significantly.
Okay, so we've got real progress, but also persistent myths creating hype. Let's put this all together for someone trying to understand Pi. The risks still seem pretty significant, right? Despite the KYC numbers and Protocol 23.
They absolutely do. And it brings up maybe the most critical question for the near future.
Which is,
can the network actually handle the selling pressure that we know is coming?
the token unlocks. Let's talk about that. Unresolved risk number 1.
Right. Token unlock pressure. Because of how tokens were distributed and vested over time, there's a schedule. And between November and December 2025, so coming up very soon, anywhere from 121 million to 172 million PI tokens are scheduled to be released onto the market each month.
Wow. 120 to 170 million tokens per month. That's huge.
It's colossal. Think about it at today's price, around 26 cents. That represents somewhere between $31 million and $45 million worth of potential selling pressure hitting the market every single month.
$30 to $45 million that the market has to somehow absorb.
Exactly. If buyers don't step up massively to meet that supply,
Yeah.
the price impact could be severe. Downward pressure.
And that ties into the exchange problem, doesn't it? Not enough places to absorb that kind of selling.
Precisely. Unresolved risk 2. Absence on major exchanges. Still no Binance, Coinbase, Kraken, and obviously Bybit is out. It is available on some others like OKX, Gate.io, BitChute, MEXC. But lacking those top-tier exchanges really limits liquidity. It limits the pool of buyers who can absorb those unlocked tokens, and it limits institutional access and trust.
Starves it of oxygen, almost.
In a way, yeah. And all of this comes back, inevitably, to the biggest risk of all.
Let me guess. Centralization.
Unresolved risk 3. Centralization. It's the foundation underpinning all these other concerns. That 96.37% of tokens in the top 100 wallets. It's just an unavoidable critical vulnerability. And it's not just the tokens. The network validators, the computers securing the blockchain transactions, they're still largely controlled by the core team or entities close to them.
So the team controls the supply and the network infrastructure.
To a significant degree, yes. And that level of centralization makes the entire ecosystem highly vulnerable to potential internal manipulation, coordinated selling, all the things we've discussed, regardless of how nice the chart patterns look today.
Okay. So given all that, the confirmed progress, the debunked myths, these huge unresolved risks, what's the realistic outlook? Short term, say, for the rest of Q4 2025, you gave it a 50-50 probability split.
Yeah, it feels incredibly speculative right now, almost a coin toss between two scenarios.
Or the bullish scenario.
The bullish scenario, maybe a 50% chance, sees the price push towards that $40.36 to 36 cents range. This assumes the technical momentum continues and the market somehow absorbs that massive token unlock pressure without collapsing.
But that's a big if, right? Absorbing $45 million a month. What would enable that absorption, realistically?
That's the key question. You'd likely need a major catalyst, maybe a surprise Tier 1 exchange listing announcement, or the launch of a truly killer dApp on the mainnet that drives real demand for Pi. Something significant to counteract the sell pressure.
Absent that catalyst.
Absent that, the risk shifts heavily toward the bearish scenario, also about a 50% probability. If that selling pressure from the unlocks hits hard, and maybe some of those big wallets decide to take profits after this recent run-up, we can easily see the price fall back down to the $15.22 range, basically retesting those October lows.
Okay, so a very fragile situation. Now, thinking longer term, forget the next few months. You laid out 5 pillars needed for Pi to maybe achieve sustainable value, say above 50 cents. What were those again?
Right, the 5 pillars for potential long-term legitimacy above that speculative range. 1, actual utility, real-world use cases for the Pi token. 2, decentralization, meaningful reduction in core team control over tokens and validators. 3, transparency, clear communication and actions from the core team, especially regarding funds and token movements. 4, major listings, getting onto exchanges like Binance or Coinbase. 5, regulatory clarity, a clear understanding of how Pi fits into global regulations.
Okay, those make sense. Looking at that list, which one feels like the biggest hurdle right now, the hardest one for them to actually achieve?
Honestly, pillar number 2, decentralization.
Really? More than utility or listings?
I think so, because so much of the project's current structure, maybe even its funding model, seems built around that core team control. Voluntarily giving up that control over the token supply, over the network validators, that's a massive structural shift.
A fundamental change to how they operate.
Exactly. And arguably, achieving the other pillars like getting major listings or building trust for real utility might depend on them first demonstrating genuine decentralization and transparency.
That's a really important point for you, the listener, to track. Those pillars are like milestones.
Definitely. Use them as a checklist for future evaluation.
Okay, let's wrap this up. What are the absolute core takeaways for someone trying to cut through the noise on Pi Network right now?
All right, takeaway 1, the truth. There are real technical patterns suggesting buying interest right now, and there is verified progress happening with KYC migration and the Protocol 23 tech upgrade. It's not a completely stagnant project.
Okay, takeaway 2.
Takeaway 2, the risk. The centralization is extreme. That 96% figure is alarming. The token unlock pressure in NodeDeck is a massive, immediate threat, and a history of controversy and opacity cannot be ignored.
Got it. And takeaway 3?
Takeaway 3, the myth. You absolutely have to ignore the clickbait, especially the nonsense about automatic ISO 2022 compliance magically adding value or claims of guaranteed price pumps. Do your own research based on verifiable data.
And what's the actionable advice for pioneers currently involved?
If you're a pioneer, yeah, complete your KYC, migrate to the mainnet if you want to be part of the active ecosystem. But understand, based on everything we've seen, this is not a guaranteed get-rich-quick situation. Far from it. Be patient, be realistic, and only trust official sources like the core team's website, mindpi.com, not random social media hype.
Good advice. The source material also suggests that for anyone thinking long-term investment, minimizing risk means waiting for key milestones, like a clear audited report on what happened with that $100 million venture fund.
Critical for transparency.
And verifiable proof that the network validators are actually becoming decentralized, not just controlled by the team.
Exactly. Those are concrete signs to watch for.
Which leaves us with a final thought for you, the learner. In an ecosystem this centralized, where almost 97% of the supply sits in just 100 wallets, how much verified technical progress, like Protocol 23 or KYC numbers, is actually enough to outweigh that fundamental risk of internal manipulation? Where do you draw the line?
Something to really mull over.
Indeed.
Yeah.
We'll leave you with that question. Thanks for joining us on The Deep Dive.
See you next time.